Bloomberg Audio Studios. Podcasts, radio, news.
This is Bloomberg Intelligence with Alix Steele and Paul Sweeney.
The real outperformance has been in U.S. corporate high yield.
Are the companies lean enough? Have they trimmed all the fat?
The semiconductor business is a really cyclical business.
Breaking market headlines and corporate news from across the globe.
Do investors like the M&A that we've seen?
These are two big-time blue-chip companies.
The window between the peak and cut changing super fast.
Bloomberg Intelligence with Alix Steele and Paul Sweeney on Bloomberg Radio.
I'm Alix Steele.
And I'm Norah Mulinda, filling in for Paul Sweeney.
On today's Bloomberg Intelligence show, we're going to dig inside the big business stories impacting Wall Street and the global markets.
Each and every week, we provide in-depth research and data on some of the 2,000 companies in 130 industries our analysts cover worldwide.
Today, we'll take a look at why TD Bank is exiting its stake in Charles Schwab.
Plus, we'll discuss why sales at the fast food giant McDonald's improved last quarter.
But first, we take a look at earnings from the farm machinery leader Deere.
This week, Deere said that North American sales are expected to be down 30% this year.
For more, Norah and I were joined by Christopher Ciolino, Bloomberg Intelligence Senior U.S. Machinery Analyst, and we first asked Chris for his take on this week's earnings report.
We knew going into the quarter that it was going to be a pretty ugly print, but these results were really, well below even some of the most bearish expectations. The company really continues to underproduce retail demand across the board to bring down some of the excess inventories that the industry has been plagued with. We also, it sounds like some products, there were some timing issues, so products got pushed out till subsequent quarters, which weighed on the 1Q performance. Now, Deere did reaffirm its 2025 net income outlook, and it certainly seems that we are approaching a cyclical trough this year. But just our concern lies that, earnings may not be fully de-risked here. You continue to see further softness on the large ag side. Used equipment inventories remain somewhat of an overhang. Currency headwinds are going to be more pronounced in the back half. And really, we still have this uncertainty around what the U.S. trade policy is going to be.
Exactly.
and what those retaliatory actions are going to be as well.
Well, I was going to say, if they sound relatively confident there'll be a trough, but then you add on tariffs, how well does that confidence hold up?
Yeah, that's the million-dollar question, right? I would say that ag historically has had a tremendous amount of pricing power, in Deere in particular. This is a company and a market that even gets positive price in down markets. This quarterly sales were down over 35%, earnings down significantly, and we were still up on pricing. It will add costs, but they have a history and a track record of being able to pass those through.
What has really been the concern for investors out of this report as they're looking forward?
Yeah, I think there's two big concerns here. One is, the expectation is that, yes, 25 is trough and that we should start to see this recovery build into 26. But I still think there's a lot of uncertainty out there as to what the recovery trajectory looks like. Just given the uncertainty around trade and tariffs, I think we're probably looking at a lower for longer type cycle. So maybe we don't get that typical acceleration in the first year after a cyclical trough. So I think investors are still trying to digest that. And then two, the cost side of the equation. It certainly seems that costs are going to go up. How are they going to mitigate that through some of their internal initiatives or even from shifting some production around with their footprint?
I also am wondering where we are in terms of the cyclicality of equipment. Like, are farmers operating on older stuff that they're going to have to replace, or did they already do that, say, during the pandemic, so they're good for a while, and it's going to take, really new high-tech products to get them to fork over that kind of cash?
I think we're good for a little bit of time here. You have to remember, we had 3-4 strong years of growth up to the 2023 peak. Yes, 24 was a down year. We were down 15-16% in terms of units on high horsepower equipment. We're looking at somewhere of a 25 to 30% decline in volumes this year. So that's going to put us at lows of over the last 2 decades where we haven't seen before. So from these levels, we think there's probably limited downside risk, but farmers still have the ability to push out some of these replacement purchases at least for another few years, we think.
Our thanks to Christopher Ciolino, Bloomberg Intelligence Senior U.S. Machinery Analyst.
We move next to the energy sector. This week, shares of the British oil giant BP surged the most since 2020.
This came after news that the activist investor Elliott Investment Management said it built a stake in BP.
And this comes as Elliott seeks to end years of underperformance at BP by pushing for significant change.
For more, Alix and I were joined by Will Hares, Bloomberg Intelligence Global Energy Analyst.
We first asked Will what all of the problems are that Elliott wants to fix.
I think there's too many to really go through given our time constraints here, but I think they can really boil down to a significant moment, which was the original rollout of their 2020 energy transition strategy. This was the quickest, most risky energy transition of all the global energy majors, and it sort of it depicted a pretty quick drop in their upstream hydrocarbon production, a really rapid rollout of their renewables portfolio. And obviously, this has not been taken well by the market. It's undermined the sustainability of their distribution. It's hit their returns, and especially now when we are seeing a sort of backlash against ESG, we're seeing a slowing of energy transition paces across this sector. Mm-hmm. It hasn't gone down well for BP's financial performance or share valuation.
So, Will, if we go back to that moment in 2020, and I was there when they laid out this new strategy, was that a bad strategy or was it bad timing or some combination?
There is some part of me that has a little bit of sympathy for BP because I think they were trying to do the right thing, and then of course Russia's invasion of Ukraine sort of upended the global energy sector pretty materially. I also think that they were, yes, trying to do the right thing, but doing the right thing isn't always what's best for investors. And I think just comparing it to some of their peers, particularly Shell, which has taken a much more capital disciplined approach. They have a very high bar for acquisitions. They've been very prudent in their energy transition rollout, and we can just see in the financial performance and how the market is valuing them, which has been the more successful strategy over the last 4 or 5 years.
As we think about BP in particular, what really can they do in this moment? What are investors really looking for?
So I think I think I'll touch on what Elliott is, I think, going to try and do. There's 4 levers that I think Elliott might try and pull here. And the first is transition business spinoff. So this can remove debt and capital intensity of these businesses off the balance sheet. We think that they'll push to focus on growing their oil production more. The current oil production is supposed to be declining about 10% to 2030. We can hope to see that flatten or increase up over that same time period. And I think there could be a push for a board change. The chairman of the board, Helge Lund, has overseen BP since 2017, and compared to peers, there's been pretty underwhelming performance there. And then finally, a primary U.S. listing. I think that this could be a big game changer. It has not only been discussed at BP, but amongst the other European majors. It's seen as a major hurdle to starting to close that valuation gap with Chevron and Exxon.
Our thanks to Will Hares, Bloomberg Intelligence Global Energy Analyst.
We move next to the leisure sector. Bloomberg Intelligence recently gave its 2025 outlook on cruises and theme parks.
And for more, we were joined by Jody Lurie, Bloomberg Intelligence Senior Credit Analyst.
We first asked Jody what she expects to perform well for cruise lines this year.
I will say that the most fascinating thing is the momentum continues for the cruise lines. The booking rates continue to be very high. And we're seeing that with Royal Caribbean, we're seeing that at Carnival, and that's what management is communicating. Whether or not that continues into 26 is the question that we're grappling with, but at least for 25, it's very, very positive at the moment.
Jody, it seems like demand out there for experiences is still very strong. How about for a family that's thinking about a theme park trip versus maybe a cruise? How does that kind of shake out?
Yeah, so Paul, I think you hit on the major issue is that we're seeing these sort of 2 sets of consumers, right? The lower end consumers that are paring back, or they're still doing experiences, but maybe not as lavish an experience. And then you have the high end consumers that are still doing very well. High end hotels are doing well. High end cruise lines are doing well. anything that's higher end. Now, if you put that in the perspective of theme parks, one thing that we saw in our survey that we ran in November is that for theme park vacations, the average consumer's income level is a little bit lower than the average consumer that's planning to do a cruise vacation this year. So I think that's pretty telling when you think about the cost of admission, when you think about who the target audience is, and what's going to continue the cash flow generation for the cruise lines versus what might be a little bit of a sticking point for the theme parks.
Jody, one of the earliest memories I have of the very earliest days of the pandemic was these cruise lines rushing out to the bond market to raise cash because they knew that their business was in for a tough haul there. How are the balance sheets of some of these big cruise companies, theme park companies? How are the balance sheets these days?
So we're going to break it out to the cruise versus the theme parks in terms of their balance sheets. So for the cruise lines, particularly Carnival and Royal Caribbean, they are dead set on getting to investment grade level metrics. Norwegian says that they want to as well. They've never been investment grade rated, but Carnival and Royal Caribbean are really set on keeping leverage very low. They're focused on that. Carnival's targeting 3.5 times by the end of next year, so 2026. Royal is targeting below 3 times this year. What we've modeled out is that they can both get there and get there relatively comfortably. I mean, they've been pretty aggressive in terms of deleveraging, bringing down the debt load. Viking is pretty happy where it is, so we don't see them improving much, but they also have low leverage. Now, if you think of the theme parks, they repaid their debt. They had this gravy of a year in 2022. Everybody rushed to theme parks, regional theme parks. Since then, it hasn't been as exciting, 2022 to 23, I should say. And what we're seeing there is a little bit more of a problem. Now, SeaWorld really doesn't have that much debt outstanding. So where we're concerned there is that they start getting creative with their balance sheet again, particularly if they're finding issues in the business as a whole and they need to propel sort of the equity value improving. For Six Flags, they had the merger between Six Flags and Cedar Fair, and that is resulting in much higher leverage. Management already bumped out the target of when they're bringing down leverage, and we already think that it might be a little bit harder to achieve, even pushing it out by a year and a half.
Our thanks to Jody Lurie, Bloomberg Intelligence Senior Credit Analyst.
All right, coming up, a conversation with the Chief Financial Officer over at Huntington National Bank on the firm's outlook and opportunities ahead.
You're listening to Bloomberg Intelligence on Bloomberg Radio, providing in-depth research and data on 2,000 companies and 130 industries. You can access Bloomberg Intelligence via BI Go on the terminal. I'm Norah Mulinda.
And I'm Alix Steele, and this is Bloomberg.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
I'm Alix Steele.
And I'm Norah Mulinda, filling in for Paul Sweeney.
We move next to the banking sector and Huntington National Bank. Co-host Paul Sweeney and I were recently joined by Zack Wasserman, Chief Financial Officer at Huntington National Bank.
He discussed where the firm's focus has been and how it's never been better positioned to benefit from significant organic opportunities ahead.
And Zack began this portion of the conversation by discussing how the bank is now trying to expand beyond lending to small businesses.
The business has been performing exceptionally well recently, and one of the reasons is because we're driving expansion, both geographically and in our commercial business, expanding in a number of specialty vertical areas and national business lines. Just this year, we've launched into 3 new states, North Carolina, South Carolina, and Texas. And we've also established 8 new specialty verticals that are national. For example, a funds finance vertical that's supporting private equity clients, one that's focused on the mortgage ecosystem and other national, commercial areas.
Talk to us about loan growth. What I do know about the banking business, that's an important driver. So talk to us about loan growth, where it's coming from, where you're seeing it, and is it kind of in line with what you were expecting?
We've actually had very strong loan growth over the last 2 years. If you take a step back, much of the industry has been in a pretty neutral position, not actually growing. Huntington has outperformed that by about 10 percentage points. And for us, the growth is coming from both our core business, which is consumer, small business, and then mid-corporate, typically private commercial clients. And then also these new initiatives that I just mentioned before, launching into 3 new states, a number of specialty businesses. So we're seeing a nice breadth of growth, actually. One thing that's actually, a nice indication of the economic strength is we're seeing strong demand from small businesses, from our regional banking business, typically in the kind of smaller middle market client set. So it's been a healthy dynamic we've been seeing.
Before you were in this position, you also was chief financial officer to Visa, and I know that Huntington is trying to get into the payments business in a particular way too. What's the market for that, and how do you guys play and compete in that?
The market for payments is incredibly broad, and if you take a step back,
how do you categorize it actually?
Yeah,
like, is that Zelle, or like what is that?
It is so broad. The one that really needs to zoom into it. We have a number of card-based payment products. So think consumer cards, commercial cards, but also importantly treasury management, and that's really the biggest driver right now. What we're seeing in payments growth, supporting commercial clients with the ability to accept payments and then make payments in essentially every form you can imagine, Alix. So big growth driver there. One of the things that we've done recently is invest to expand our merchant acquisition capability. Merchant acquiring is when a company accepts payments electronically, and it's often the linchpin of their business. The lifeblood of the company is how they accept payments. So we launched a merchant acquiring business just in October, and it's been going incredibly well. So kind of almost every area there's growth in payments for sure, but for us, treasury management and commercial payments in particular is a major growth driver.
Talk to us about your loan portfolio, specifically your exposure to office real estate.
Office and commercial real estate generally for Huntington is a very small exposure, actually. Typically for large regional banks, the average commercial real estate within the loan portfolio might be 15 or 20% of the loan book. Okay. For us, it's 9%. Okay. So we're relatively smaller, and an office is only 1% of that 9, to give you a sense. With that being said, what we're seeing in that commercial real estate environment is this is going to be a situation that plays out over multiple years. Thankfully, we are seeing a fairly orderly process of refinancing and generally seeing pretty sound ability for our commercial real estate developers to maintain their financing and to successfully roll through maturities. But it'll take a while to run through. To give you a sense, something like 20% of the portfolio matures any given year. So this will be, on average, it'll take 5 years to really roll through. So I think that's a kind of an industry dynamic we're seeing, this is a dynamic that will play out over quite some time.
What part of this encompasses any kind of M&A? Versus organic, I guess.
For us, we're focused on organic growth. M&A, it can be a tool for banks to grow. Certainly, we've seen M&A in the industry over time. With that being said, it can also be distracting to the progress that the company is making on organic growth. And for us, Alix, we're seeing so much progress on our organic growth initiatives, both acquiring customers, but also, importantly, putting more and more focus around the value-added fee services that come to them, namely payments, wealth management, and capital markets. And so, just the customer acquisition we're seeing, the success in those businesses, that's where our focus is. To give you a sense, in the fourth quarter, that we just closed, a 10% year-over-year revenue growth, really driven by those organic strategies.
Okay.
What's a typical corporate customer for you guys?
Often, Paul, they are middle market companies that are private. That's the most typical company. The regional banks serve a really important niche within the overall U.S. economy because the client set that we are servicing are typically focused on their local market. They want to bank with a company that is deeply embedded in the community and knows them personally, but importantly can bring down to them the power of a large bank in terms of specialized capabilities. It's actually one of the reasons why we've been so successful in these new geographic launches.
Well, how about private credit? Is that a competitor to you?
It's funny, we get this question all the time, and the answer generally is no.
Okay.
Private credit is looking for the kind of loans that they finance are typically where there's more leverage, where there's more yield to be had because of the risk. That's not the core client for Huntington, and so our head of commercial business mentioned that only in 2 cases last year across our entire business did we see commercial borrowers actually go to a private credit facility away from our own lending facility.
Our thanks to Zack Wasserman, Chief Financial Officer at Huntington National Bank.
All right, staying in finance, this week, Canada's TD Bank said it's offloading its entire 10.1% stake in the financial services firm Charles Schwab.
And this comes as part of a corporate overhaul. In October, TD Bank reached a settlement with the U.S. Department of Justice and bank regulators over its failure to catch money laundering at several American branches.
For more, Norah and I were joined by Paul Gulberg, Bloomberg Intelligence Senior Equity Analyst.
We first asked Paul why TD Bank would offload its full stake in Charles Schwab.
I don't think it's necessarily strategic, Alex. I think it's partially to simplify the business. Also, TD got hit with AML investigation and was fined and got an asset cap in the U.S., so they can't really grow in the U.S. much larger on the banking side. It sounds like they're trying to simplify the business, have an ability to buy back some stock, have some extra capital on hand.
Where does TD's business currently stand if you were to give us a broader perspective? How is it lining up against competitors?
Well, I think that you have to look at it in two different areas. One in Canada. So in Canada, they're one of the largest banks across personal and commercial banking. In the U.S., they, again, one of the largest banks, but they're very much personally focused all over the east coast of the U.S.
So what is going to take for them to get their asset cap raised in the U.S.?
I think it'll take a long time.
But what's the problem that the Fed highlighted?
Well, the Fed highlighted is the AML deficiencies, which they're trying to fix. It costs them a lot of money. They invested in it, but it can take years. So if we'll look at what's happening to Wells Fargo, we're in 8 years, and they're still trying to get out from under that.
Yeah, and
cap.
it always seems like nebulous. It's like we have an asset cap, but it's not like you check these 3 boxes and it's gone. Right. It's sort of like, well, at least for Wells Fargo, because it's like risk management, it's controls, it's making sure that everyone's on board, doing the right thing at the right time, which can be very difficult.
What do you take away from this idea of the repurchasing of its stock?
For TD or for Schwab, they're both kind of doing. So for TD, I think they're repurchasing only a fraction of that. So the stake in Canadian dollars is about 20 billion. So that 14 billion, they're repurchasing only 8. So the impact on TD shares from the sale of Schwab shares is about 7% of the earnings. They're going to repurchase back 6. So mostly neutralize that kind of impact. The rest is going to add about a whole point of capital to them, so that they can be invested in other sides of the business, but because they're kept in the U.S., which makes it very challenging because they'll have to figure ways to reinvest it either into capital markets, which they're doing right now, or domestically. For Schwab, they only buying 1% of the 10% stake that's being sold, but TD is still keeping the depository relationship, so I think it's strategic more on the TD side rather than having any impact on Schwab side.
Is this bad news for the Schwab side of things?
I don't think so. That's what I'm saying. It's a strategic decision on TD's side to simplify their business. They're still keeping the deposit relationship, which clearly says that they're working well with Schwab. And TD is going to book a decent gain on sale and this kind of thing. So I think that's nothing wrong with the Schwab. It's just big stake of the company is going up in the open market.
Right.
Totally switching to TD and their actual Canadian business. How are they doing there?
They're doing pretty well, right? So they're second largest bank domestically, right after the RBC. They've been very consistent, right? On the mortgage side, on their commercial operations and everywhere. So they've been doing well, but it's an extremely competitive market. That's why the concern is that they're going to have this all extra capital that they're going to try to reinvest domestically into a super competitive market.
And breakdown in Canada, there's fewer banks than we have, 1 million over here. So how do they shake up in terms of their competition in Canada? How do they line up there?
Well, their competition, their 6th largest banks, or some people call it 5+1 because National Bank is a little bit smaller, even though they just finalizing the closure of Canadian Western Bank that's going to expand them a little bit. But some people describe that market as a competitive monopoly between these banks. So there's some smaller banks and credit unions, but these banks control 90+% of deposits and loans in the country. So very, very concentrated. And they compete very aggressively against everything. So the market shares, when you see them shift, we're talking about basis points here and there from period to period.
Our thanks to Paul Gulberg, Bloomberg Intelligence Senior Equity Analyst.
You're listening to Bloomberg Intelligence on Bloomberg Radio, providing in-depth research and data on 2,000 companies and 130 industries. You can access Bloomberg Intelligence via BI Go on the terminal. I'm Norah Mulinda.
And I'm Alix Steele, and this is Bloomberg.
You're listening to the Bloomberg Intelligence Podcast. Catch the program live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
I'm Alix Steele.
And I'm Norah Mulinda, filling in for Paul Sweeney.
We move now to earnings from the fast food giant McDonald's.
This week, McDonald's reported that its sales rose in the fourth quarter. And this comes after growth in the chain's international business made up for a decline in the U.S.
For more, Norah and I were joined by Michael Halen, Bloomberg Intelligence Senior Restaurant and Food Service Analyst. And we first asked Michael for his broad read on these latest results.
You know, the most important piece of the report really is the U.S. recovery post E. coli, and we got some good news on that front. So traffic was actually positive in December, so I think that was much better than anyone had expected. They cited kind of a choppy January here, but the only region still impacted by E. coli seems to be the Rocky Mountain region where the outbreak occurred, and they expect a full U.S. recovery by the beginning of the second quarter, which is good news.
What about the rest of the world versus the U.S.? It was the rest of the world that really performed well, yeah?
Yeah, and a big part of that was just lapping like pretty weak year ago results, right? So we lapped the start of the Israel-Hamas war, and so the Middle East was stronger. Countries with large Muslim populations were also stronger. And then also China lapped a very weak result last year, and management cited some stabilization in that market, which is encouraging for them. So the easy comps was what really fueled international sales. You know, we're kind of more bullish on the U.S. moving forward than international, you know, because outside of the Middle East and China, Europe is we think is going to continue to kind of be an issue for them. The Eurozone is experiencing much higher inflation than the U.S., and that's really crimping low income and family spending on the continent.
Are people still buying the Big Mac?
They don't break out Big Mac sales, but they cited pretty strong results out of the chicken Big Mac, which I was kind of surprised about. You know, my associate tried it; he was not a big fan, but yeah, they cited pretty strong results out of the chicken Big Mac in the United States and other markets. I think France was who they called out specifically, and to the point where they're going to continue to bring it back as a limited time offer in the future.
So I was actually talking to an IB user, a Bloomberg user, about this. Why are McDonald's franchises elsewhere, like out rest of world, so much better than in the U.S. and that like you can get like super good food that doesn't taste like fast food? Like, why is that?
Yeah, Jonathan Farrow asked me the same thing. Said he wants them all to be like the McDonald's in Italy, you know. And the answer I had there was just more discerning tastes, right?
That might be it.
No, but really, like, is it? I mean, does it affect margins? Like, what are the margins like in the U.S. versus rest of the world?
We don't have that information. Okay. You know what I mean? It's a franchise business, right? So. You know what I mean? So we don't have a ton of color on all the different franchise markets and what kind of margins they pull in. You know, the U.S. Generally is a lower margin for the franchise business just because they have a lot more franchisees and need a lot more oversight. The international franchise business tends to generate wider margins.
So I always used to think about McDonald's as a really cheap place, a discount fast food place, but prices are getting higher. Are we still seeing demand from lower income consumers for the brand?
You know, it continues to be the weak spot at McDonald's, and for anyone that has a lot of exposure to low-income consumers. So the entire QSR space, right? Jack in the Box, Wendy's, Burger King. You know, a lot of chains, you know, struggled last year because of their inability to draw low-income consumers. You know, they're impacted most by inflation, right? We've had 4+ years of restaurant price hikes and higher costs across the board, right? And so, you know, chains that are exposed to low-income consumers are going to continue to press on value to try to bring them into the fold. You know, it seemed like it didn't seem like restaurant sales did improve for quick service in the fourth quarter, and we think a big part of that is just a reestablishing of their value proposition, right? Mm-hmm. McDonald's early last year got a lot of shade about the $18 Big Mac meal in Connecticut, right? And so they decided to push hard on value. And prior to the E. coli outbreak, October had some really good results. They were drawing customers in with that $5 meal deal, and traffic was positive for the first time during the year. So pushing on value has been successful for McDonald's. That's not good for their competitors because McDonald's has the most scale, right? But we think this is going to continue throughout 2025 in the quick service industry.
So just to confirm, you're saying there was a meal that came up to $18.
She totally missed this one.
Yeah. It was one franchisee in Connecticut.
Right, had to be.
No comment.
No, fair enough.
But also, he was pushing back because he was dealing with a lot of inflation, and he was just he wanted to make some money on the Big Mac meal. He was trying to make a point.
Our thanks to Michael Halen, Bloomberg Intelligence Senior Restaurant and Food Service Analyst.
Each week, we look at research from Bloomberg NEF, previously known as New Energy Finance. They're the team at Bloomberg that tracks and analyzes the energy transition from commodities to power, transport, industries, buildings, and agricultural sectors.
This week, we looked at the energy sector and how it's being impacted by Donald Trump's presidency in the United States. For more, Alix and I were joined by Derrick Flakoll, BNEF lead U.S. policy analyst.
We first asked Derrick where we stand today with the energy transition.
Where we stand today is at a point of uncertainty and early consolidation. At this point, we've heard a variety of conflicting reports about the release or lack thereof of obligated federal funding for climate grants. We've heard reports that EPA has released some, others that are implicated by some of the president's DEI-related orders, anything with an environmental justice or a community benefits component have been more affected. And meanwhile, at the executive level, we've seen some people like Brooke Rollins at the USDA, Doug Burgum at the Department of Interior, and Chris Wright at the Department of Energy get into place and put forward their formal priorities. So with that early staffing up in place and continued uncertainty about the release of funds, we are kind of looking at a wait and see period, seeing how things shake out in the courts and in the executive branch itself.
Well, it definitely has been a massive makeover that Trump has been planning to do and is continuing to do right now in terms of federal agencies. But are there any areas in particular that you're keeping an eye on? I know that there's things going on in terms of EV charging funding.
Right, absolutely. I mean, sectors that were specifically named in Trump's executive orders, oil and gas, there's supposed to be forward momentum on that, as well as electric vehicles and electric vehicle charging and offshore wind in particular. EV charging saw a pause on existing disbursements of funds from the National Electric Vehicle Infrastructure Program. That's about $5 billion, if I recall correctly, from the Infrastructure Investment and Jobs Act. About $1 billion of that had been allocated. So it's clearly a disruption to those ongoing disbursements. Mm-hmm. Keep in mind that there's also something called the Charging and Fueling Infrastructure Program, which was not as directly targeted by that, that's obligated rather more funding. So there's still some forward momentum so far to the EV charging sector, but what this does is throw a bit more sand in the gears of that continued forward movement.
Do we know what the Republicans' energy plan consists of versus just rolling back certain things? Like, we know that it's energy independence and we want more oil. Like, I get that. But in terms of dismantling Democrat policies versus their own support for different industries?
I don't think we do, and there's two different reasons for that. Firstly, on the executive side, my sense is that they are reviewing and looking to see which aspects of existing policies are worth keeping in place for goals like national security, energy independence, and so forth. Certainly, we've seen emphasis that subsidies for nuclear, critical minerals, manufacturing, those should continue. And to the degree that renewables can help meet new load for new factories, for data centers, that might also be somewhat protected. We've seen these reversals quite rapidly, even in the renewables permitting space, for example. Within the same day, our colleagues at Bloomberg News reported that solar federal permitting was paused and then unpaused by the U.S. Army Corps of Engineers. That's just the federal side, executive side. On the legislative side, we are still waiting for the Senate and the House to come together on one core plan for the big tax and reconciliation bill that's going to come later this year. They need to find a lot of pay-fors to extend Trump's tax cuts from 2017. And other than being sure that they want to sell more oil and gas leases and cut back taxes on methane, they're not really consolidated around one common plan of movement. The House wants to do one big, beautiful bill. The Senate wants to have an early energy measure. And of course, the earlier you move on some of these big unifying factors like the border or like increasing supplies of fossil fuel energy, the harder it will be to have consensus on doing some other, maybe more controversial things like pulling back clean energy subsidies that have mostly benefited Republican districts and states. So we're really waiting to see where these negotiations land. And I think the more that businesses continue to engage with the Trump administration to make the case for their priorities in Trump's own terms, the more we'll see clarity around where this administration will land ultimately.
So with the new administration in power, where do things stand with Biden's Inflation Reduction Act, particularly tax credits?
Right. So the key thing about tax credits is that these are a bit more of a complicated instrument than simple grants and loans, right? There's legal obligations that are associated with those, but there's also a lot of sort of intervention points to try and keep that money back. With taxes, that's a thing that you file to the IRS. The IRS eventually gives back to you. And further complicating this, the IRA created a sellable tax credit market. So right now, there's a lot of businesses that effectively have anticipated getting tax credits from the government later and used that to sort of set up some transfers with other businesses in advance. Everything is kind of moving along before tax day comes and before IRS disbursements needs to come back. But because of all of that, there's a lot less certainty right now about whether tax credits are affected by this alleged funding freeze. And of course, that it's sort of like, the roadrunner running off of a cliff in a cartoon. As long as you don't look down, maybe there's not as much fall as you would expect. We're going to see later on what real implications this has. Now, from what I've read of legal analysis, it's going to be particularly hard to try and hold back tax credit funding, even if, there's a longer wait on that. But that level of uncertainty has yet to affect the market, to my knowledge. Later on, though, we'll see.
Our thanks to Derrick Flakoll, BNEF lead U.S. policy analyst.
This is the Bloomberg Intelligence Podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live each weekday, 10 a.m. to noon Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.